Okay, I think we'll get going here. As Steve mentioned this morning, the way the day is unfolding here is that we had hoped that by this point in the day we had had through Commissioner Bill and Senator Tester some of the overview and big picture perspectives on the Wall Street Reform Bill. In these next couple panels, what we hope now is to start jumping into the weeds a bit more, and we've are privileged to have some people who I think can address that from positions of expertise and knowledge. And in order to save some time on introductions, what I'm going to do is invite you to look at their bios, which are in your blue packets, and I'll just introduce them by name. We're going to go in order here, and I'll begin with our first speaker, which is Karin Baers, who is a senior examiner with the Federal Reserve Bank of Minneapolis. And again, I invite you to Karin's bio for further background, and I'm going to now turn it over to her.
Good afternoon. It's a pleasure for me to be here today. My very first bank exam was in Bozeman, so I have had the fortune to come to Montana a number of times and really love it out here, and I've enjoyed all the people that I've met over the years, so I'm really happy to be here today. What I'm going to be talking about, or try to talk about in a relatively short amount of time, so it's going to be fairly high level. What does this law mean for banks, primarily? My role with the Federal Reserve Bank of Minneapolis, we examine banks, state banks that are members of the Federal Reserve System. We have a staff that conducts safety and soundness examinations, and we have a staff that conducts consumer compliance examinations, the types of laws that we've been talking about today. And all of the federal regulatory agencies are set up that way, for the most part. We do it a little bit differently, but we all have safety and soundness responsibilities and consumer compliance responsibilities. So how is that going to change now with the new bureau that we've been talking about? Well, there's really two things I think that are how banks will be affected by this change. One deals with the bureau's new regulatory responsibilities with regards to consumer protection laws and regulations, dealing with issuing rules primarily. So the bureau will take on rule writing authority for a number of consumer protection laws and regulations, including the Truth in Lending Act and the Equal Credit Opportunity Act, and a number of others that will move from the Federal Reserve to the Bureau. Several others will come from other agencies. So the Real Estate Settlement Procedures Act, RESPA, responsibility for writing rules under RESPA, will move from HUD to the Bureau. So for the first time, you'll have both the Truth in Lending Act and RESPA under the same agency. So that they will take on responsibility for these current rules. They will also have responsibility under the Wall Street Reform Act for issuing a number of rules under a lot of the statutory amendments that are in the Wall Street Act that deal with consumer protection. And if I have time, I'll mention a few of the more significant ones in a minute. And then also, the Bureau has, as others have mentioned today, fairly broad authority, including to issue rules that relate to unfair, deceptive, and abusive acts and practices, which is a fairly broad responsibility. And a lot of the Act provides resources for the Bureau to monitor changes in the industry. For example, they're going to have a research function with the responsibilities of looking at what's changing in the industry, what are some practices that may be abusive or unfair. So they'll have resources to try and monitor that. They'll also have a centralized consumer complaint function with the idea of both responding to consumers' concerns, but also providing the Bureau with data on where are there concerns in the industry, where are consumers having issues with financial institutions or others. So there are resources and tools for the Bureau that way. The other function, which I believe one of the questions was asked earlier, deals with the Bureau's examination and enforcement authority. And as I mentioned, currently, all of the Federal Reserve banks and the other agencies have responsibility for monitoring compliance at banking institutions. The largest institutions, those with 10 billion or more, the examination and the enforcement authority for consumer compliance will move over to the Bureau. Montana banks, being under 10 billion, will keep their same primary regulator. So for example, I've got several representatives here today from some of the banks that we regulate. We will continue to go in and do those exams for those institutions under 10 billion. The Bureau, as also mentioned, I think it's going to be talked about a little bit more detail later, will have authority for the first time over a lot of non-bank institutions and will have examination and enforcement authority. So for example, they will be able to go in and examine a payday lender or a private education lender, which is a new examination authority. One thing I'll note, that the Community Reinvestment Act is not covered by this law. So currently, we, in addition to examining for consumer compliance, we also examine banks for the Community Reinvestment Act, whether banks are meeting their community credit needs appropriately. That responsibility stays with the primary regulator. So even the banks that are over 10 billion will continue to be, for example, our banks, we don't have any, but say I'll use the Atlanta Fed, for example. The Atlanta Fed has a number of banks that are over 10 billion. They will maintain responsibility for the CRA examinations, but their compliance examination responsibilities will move to the Bureau. That will require a certain amount of coordination because under the Community Reinvestment Act, we do look at a bank's fair lending record when assessing its community reinvestment performance. So there will need to be some coordination with the Bureau in that regard. But the primary CRA responsibility will stay with the primary regulator. There are, as I mentioned before, now we're not sure what role the Bureau will have in the examination process. We know that they'll be issuing the regulations, we know that they'll be interpreting the regulations, and they'll have a fair amount of authority over the industry with regards to consumer protection. We don't know at the examination level, particularly for those smaller institutions that are under 10 billion, what role the Bureau will have in telling us what we should be looking at and what kind of exam process we should follow. So I think that is an unknown that we'll have to see how that works. There is language in the law requiring coordination with states and with the other federal agencies to try and ensure that we are all being as consistent as possible in how we enforce these laws with our institutions. And I thought I would just also mention a few significant, I guess there are also a few additional things I wanted to mention. The Bureau has a number of offices now that are geared towards certain interests. One is an Office of Fair Lending and Equal Opportunity, so monitoring the implementation of fair lending laws and how that's working. There's also an Office of Financial Protection for older Americans, defined as individuals over the age of 62, monitoring developments in that market. One of the examples there would be reverse mortgages, which is a more common product for older Americans. Another office related to service member affairs, so ensuring that service members are treated fairly in their dealings with creditors. And then also an Office of Financial Education, which we talked a little bit about the importance of that earlier. That's another function of the Bureau to supplement the regulatory side with also educating consumers about their rights. So that's a part of the Bureau as well. There are several significant changes in the statute related to consumer protection rules. And basically the statute outlines a number of changes that need to occur to several of the statutes, namely the Truth in Lending Act. And so the Bureau will have responsibility once the transition date arrives, which is July 21st of next year. They'll have 18 months to issue new regulations under some of these statutory changes that I'm going to mention. One that's fairly significant that will affect all banks deals with collecting small business loan data under the Equal Credit Opportunity Act. Currently, if you are an institution located in a metropolitan statistical area, Missoula is one of them, you have to collect what's known as home mortgage. You have to collect data on mortgage loans under the Home Mortgage Disclosure Act. This is a new requirement requiring similar data collection on small business lending, really geared at trying to determine the level of lending to women-owned and minority-owned businesses. So that'll be a fairly significant new responsibility for financial institutions. They'll also have to gather additional data for the Home Mortgage Disclosure Act, information that's previously not provided, such as a credit score, age, and other information about the borrower. That type of information is gathered and aggregated on a nationwide basis, so that does become public information. The personal information about you as a borrower is not given, but your aggregate information about the bank and its lending is provided. But I think the most significant statutory changes related to the laws that we deal with is in the mortgage area. And a number of these things will apply beyond non-bank lenders. They will apply to traditional bank lenders as well. Most significantly, I think, is a requirement to ensure that a borrower has the ability to repay a loan. So we talked a lot earlier about making loans to individuals that they simply could not afford. And this statutory change will require institutions to verify income, check an individual's debt-to-income ratio, and such to ensure that they can afford the loan. There is a similar requirement in Regulation Z right now that deals with higher price mortgages, so it's somewhat similar to that. And the challenge has been in implementing that rule with an institution. How do we prove that we verified repayment ability? How do we show you as a regulator that we've done that? And this law has a presumption for a qualified mortgage, that if you originate a qualified mortgage, we're going to presume that you have verified repayment ability. And basically a qualified mortgage is a very simple, straightforward mortgage. So it's got a 30-year term. It doesn't have interest-only payments. It doesn't have a variable rate that can change significantly. So there's simple mortgages, and if you originate one of those, you have a presumption about repayment ability, but you still have to check income and obligations on those mortgages. And then it also addresses what is termed in the law as non-standard loans. So those are the loans that caused the most pain and anxiety in the industry. The interest-only mortgages, the payment option ARMs, where an individual could choose a very low payment, but the payment's not going to pay off the balance, and you're stuck in a situation with when the rate raises and your payment goes up significantly, you're not able to pay off the mortgage any longer. So those kind of non-standard mortgages will have additional repayment, additional obligations to verify repayment than is currently required. And then just a couple additional significant changes. Mortgage originators can no longer be compensated on anything other than the loan amount, which is a really significant change. Brokers have, for a number of years, been able to, they'll get a buy rate from the bank, and the broker will be able to set the rate higher than that buy rate. And there's a lot of concern about consumers not understanding how that works. and being charged higher rates than maybe is appropriate. So that's a new restriction on mortgage originator compensation. Also limits on steering individuals to more expensive loans. So steering somebody from a prime, we talked about this earlier as well, steering somebody who may be a prime borrower to a non-prime loan that's more expensive because the originator is going to make more money on that subprime loan. So new limits on that, and then also additional limits on high-cost mortgage loans. So loans that are more expensive have more restrictions, basically. And so they've expanded that in the law. Thank you.
Thank you very much, Karen. We're now going to hear, and just so you know what, we're going to go down the line here and offer each panelist the opportunity to provide some information and perspectives, and then hopefully have a few minutes for interchange and some questions. So I'm going to turn it now to Gail Hildebrand, who is a senior attorney with Consumers Union from the Bay Area in California.
Thank you. Good afternoon. Good afternoon. Let's try again. I'm very happy to be here. I want to thank Attorney General Bullock and his remarkable staff for putting this together and for all the work I know that they'll be doing with you in the state of Montana to make sure that we all get the benefits we need from the financial reform. I'm going to talk about the ways you can use and benefit from the Consumer Financial Protection Bureau once it gets up and running next July. I'm with Consumers Union. We publish consumer reports. If you subscribe, you pay my salary. And if you'd like to learn more about our financial services advocacy work, you can see that at our website, defendyourdollars.org. I'm going to give a very brief introduction to the CFPB. Then I'm going to cover 5 topics: the complaint handling function, the 2 types of rules that it has the power to issue. Then I'll spend most of my time with you talking about some of the really practical things CFPB could do for us, and probably only will do if the public is watching and the complaints are coming in and the pressure is on, because that's how government works. And then I'm going to talk about the enhanced role for the State Attorney General and for your state legislature to protect you from new scams and problems, even when there's a national bank in those. Let me say first, the Consumer Financial Protection Bureau is about fixing a broken federal government system in financial services. We've got 6 different regulators for a loan and 7 if it's a mortgage, and none of them seem to do the job effectively. And there's a GAO report basically saying there were so many of them that all they did was talk to each other. Now we're going to have one rulemaking entity for all types of loans and for most types of non-lending financial products. Mutual funds and securities, that'll still stay with the SEC. Insurance will still stay here with your state insurance department. But most everything else is going to be right under the CFPB. The basic structure there is the CFPB will have rulemaking power. It will have, for everybody. It will have supervision and enforcement for big banks and for non-banks, with some shared enforcement with the FTC on the non-bank side. It will have a strong research arm to really know what's going on in the marketplace, and it will have complaint handling. I think this really gives us a possibility for accountable government, because there'll be one place where the rules have to be written, and if the rules are not keeping up with the products or the scams, we'll know exactly where to go. And it's got to be faster than Congress, which took 10 years to give us credit card reform, and then an extra year before it went into effect. Small banks, as was mentioned, stay with their current regulator. The rules apply to the small banks, but their current regulator will be the primary oversight and enforcement, really the only oversight and enforcement for those. Let's talk about complaints. This should lead to better results for consumers. First of all, you won't have to figure out what kind of lender you were dealing with to know where to complain. You'll be able to complain to one place with a toll-free number. The complaint system, we believe, is being designed before July 2011, so it can be there at launch. At least that's what consumer advocates have recommended to the Treasury Department. And you're luckier here. You've got the AG's office, an active complaint unit. Some states don't have that. You can keep complaining to your state AG, but you'll also be able to complain directly to the federal agency, and your complaint information will feed into the internal governmental decisions about what the problems are and what they ought to be looking at, both in research and in rulemaking. Let's talk about those 2 types of rulemaking powers. The first one Karen mentioned, it's transferring over the obligation to keep the rules up to date for a whole variety of existing federal statutes. So this isn't more law, these are existing laws, but let's keep them up to date. It's things like the Fair Debt Collection Practices Act, where there will be rulemaking, truth in lending, disclosure, so-called Regulation E, which governs your debit card and electronic transfers in and out of your bank account, and the credit reporting. And I'll come back to credit reporting in a moment. So those will move over. Those are the so-called transferred authorities. And the agency's job will be to keep those up to date and to make sure that they fit together. And that's a pretty big job, but I think it's going to be important. The other type of power is not entirely new, but is expanded. The Federal Reserve Board and several, but not all of the banking agencies previously had the power to do rules against unfair or deceptive practices. And that's been expanded slightly. The CFPB will have the power to do rules against unfair, deceptive, or abusive practices. Abusive is when it's really about the characteristics of the customer, perhaps a mental disability or something else that just makes that customer a different type of customer who should be treated differently and not taken advantage of, or the circumstances of the sales transaction. There's a very detailed definition in the statute of what can be considered abusive. Deceptive, I think maybe we all know what that is. We certainly heard a lot about those issues this morning. And there's a very specific definition of what is unfair. It's not just whoever President Obama appoints gets to decide something is unfair. There's a very specific standard. The conduct has to cause substantial injury to consumers that's not reasonably avoidable by the customer and that is not outweighed by countervailing benefits. So that's the balanced standard that the agency will be working under. Now, let's talk about the practical stuff. What could the CFPB do with this unfair, deceptive, and abusive rulemaking powers? And I'm going to share with you some of the things we have suggested it should do. This went up on the Learn More site this morning. I think it's the last document on the site, and I have a few hard copies for people like me who like to hold it in their hands. So get them from me at the break. First of all, how many of you have tried to get your credit report? And keep your hand up if you found a mistake on it. Okay, now I'm not going to ask you how easy it was to fix, because I think I might know what the answer was. We hear from consumers who have a lot of trouble fixing their credit reports. And the legal standard is pretty good. Credit bureaus are supposed to achieve maximum possible accuracy, and there is a standard for how to fix your report. But we hear from consumers that it just isn't working. So the CFPB could audit the credit reporting agencies to see if they're actually meeting that standard of maximum possible accuracy on the front end. The CFPB is required by the statute to do a study of the dispute process to try to figure out why it's so hard to get your report fixed and keep it fixed. And they could use the results of that study to actually do regulations, either insisting that the credit reporting agencies do something different or insisting that those who are sending information into the credit reporting agencies take their obligation to investigate a dispute and do that more effectively. I don't know how many of you know this. This was a surprise to me. When you get your free credit report or when you pay for a credit report, the one you get is not guaranteed to be the same version that goes to your creditors. Yeah, your creditors actually get more information about you than the one that you get off the free system or that you pay for. So there's a provision in the law that says the CFPB has to study that and determine whether those differences really make a difference. We think it's pretty hard to be a responsible consumer and monitor your own credit if what you get and look at is different from what your creditors are getting. So I think we could see some action in that area. The CFPB could say, hey, it's an unfair practice to give consumers an incomplete report, something different than you're giving to the creditors. In the area of debt collection and debt buying, let me say first, people should pay their bills. You know, the best loan is the one that's been paid off, and then next best one is the one that's being paid on time. That's the best thing for everybody. But in this economy, we know that some people are facing debt collection. We featured a story about Harold Wood out of Kent, Washington in the October issue of Consumer Reports. His company went under. He owed one credit card bill, and he had 13 different debt collectors trying to collect the very same credit card bill. He actually started paying the first collector who called him, and then there were 12 more. And they were all trying to collect the same bill. And that's because his debt had been sold to multiple debt buyers at the same time. In the research unit, the CFPB could look at what's really going on there, and in rule writing, it could impose some requirements to make sure that a debt is not sold, if not at least not sold more than once, not sold more than once at the same time, which is what happened to Harold Wood. So Julie Brill said this morning the FTC called the debt collection system a broken system. They issued a strong report, but they don't have a lot of rulemaking authority in that area. The CFPB will have that rulemaking authority, and I think we'll see some responsible look at how to bring some balance into allowing people to collect the debts that are owed to them, but making sure that the person who calls you up and says, you owe me money, it really is you, they've got the paperwork, they can show you how they calculate how much they say you owe, and if it's not you, there's an easy way to put a stop to it. So we think that that will be very helpful. CFPB could look at something like putting a time limit on when debt is simply too old to be sold to a third-party collector, and we're hoping to see some action in that area. The other thing CFPB is going to do that if it does it really well, we won't see it because we won't have the problems, is to try to get the regulations to keep up with the technology. You know, every single day there's a new way to pay, right? You've all seen them. There's all this weird stuff going on online, and there's all kinds of cards in your wallet. You've got, you know, you might have 3 or 4 cards in your wallet that say Visa and MasterCard on them. One's a credit card that gives you all kinds of consumer rights if something goes wrong with the merchant. One's a debit card linked to your bank account, which gives you no special statutory rights if something goes wrong with a merchant, but plenty of good rights if your money is stolen using the card. One may be a prepaid card or a health savings account card. No one's quite sure where the HSA cards fall. But if it's a prepaid card, works like a bank account, but people holding those cards do not get the same protections that you and I have with our bank account debit cards if the money is stolen through no fault of their own. And we keep hearing that pretty soon you'll be able to push a button on your cell phone and pay that way too. The CFPB will be able and will have the obligation to try to get to the bottom of this and put some rules in place so you get the same rights to not lose your money no matter how you're paying. And that will actually free up innovation because then people like me in the consumer advocacy world can stop saying, stay away from this kind of card and that kind of cell phone because we'll have the same rights no matter what we use. And I think we have a few years to get from here to there, but there's good potential. We have the possibility that CFPB could really help us take back control of our bank accounts. The Fed did part of this job with Regulation E when they said, look, if it's a debit overdraft, you can't loan the customer money that they didn't know they were borrowing to pay a debit overdraft unless the customer signs up for that program. Pretty sensible, good rule. The Fed did it just for debit card overdrafts and not for overdrafts caused by checks and automated payments. We'd like to see the CFPB say, look, nobody can loan money to somebody who hasn't asked for a loan. If customers want this service, market it to them and get them to sign up for it. And if they don't want it, don't pop it on by accident. Bill's going to tell you Montana banks don't do this next practice, and I was very glad when he told me that over dinner last night. Wells Fargo recently lost a court case. It's on appeal, so it's not finished, in August of this year, where a federal court found that it had processed the biggest checks and payments first, so that if there was not enough money in the account, there'd be more bounce check fees or more overdraft fees. CFPB could take a close look at that and make sure that other banks don't follow that practice. There's also an interesting provision in the new law. They will have to do regulations. They will have to do regulations to allow consumers to get information about their own accounts. So if you've ever had a dispute with a lender, bank or non-bank, about how much you owe, you've got your records. You can't see their records, and this reg will allow you to do that. I'd like to, as I wrap up, mention a couple benefits we already have from the new statute that are not necessarily CFPB related. Our bank accounts are safer today because the temporary $250,000 deposit insurance cap was made permanent. You think, yeah, nobody's got that much money in the bank, but a life insurance payment might be that much, and that's important to protect. Our employers' payroll accounts are safer because the unlimited insurance for non-interest-bearing accounts, usually those are accounts holding our payroll money, has been made permanent. You'll get more of your deposits sooner. We got a partial improvement there. The amount you could get on the next business day was $100. Now it's $200. We still need to work on how long the check holds can last. And retailers may get some relief on debit card interchange depending on how the Fed implements those rules. You heard about the mortgage stuff, so I'll just add one more. There's a provision in the new act that the bank has to credit your mortgage payment the day they get it, bank or non-bank. If you send it to the wrong place and they accept the payment, they have to credit it within 5 days. If you send it to the right place, it has to be credited on the same day. And finally, Congress did something they almost never do. They gave some power back to the states. The term is preemption, but what it really means is displacement of state law. Congress didn't eliminate it entirely, but they reduced it. It means that your state attorney general is going to have a clear power to sue anybody who breaks federal or state law, including a nationally chartered bank or its affiliates and subsidiaries, which has been a roadblock in the past. And it means that your state legislature will be able to pass laws that apply to all the competitors. If you're a state chartered bank and you've seen these state laws coming up and they don't apply to your national bank competitors, your state legislature will now be able to do that as long as it doesn't discriminate against the national bank and the new law doesn't prevent or significantly interfere with the ability of the national bank to do business. And that's a pretty stiff standard. So that means if you're not happy, you should be telling your AG now what things need to be solved in the marketplace so he can feed that information into the CFPB when it gets going. You should tell your state legislator what you think should be different, because for the first time, effective this July of 2011, your state laws will actually apply equally to state banks and national banks. Thank you.
Thank you, Gail. We'll now turn it to Annie Goodwin, who is the Commissioner for the Montana Division of Banking and Financial Institutions. Go ahead.
Thank you, Jim.
Is there a...
Thank you. There might be a switch. Here you go.
Bill probably turned off the microphone.
Because you're my regulator.
Good afternoon. I appreciate the opportunity to be here with all of you this afternoon, and I do thank Attorney General Steve Bullock for the invitation to this meeting. Our Division of Banking is a Montana agency, and the Division of Banking and Financial Institutions is a part of the Department of Administration. And basically the purpose of our agency is to protect customers' deposits of money in our state chartered banks. We have 64 state chartered banks in Montana. One half of the banks, roughly one half, are Federal Reserve member banks. In other words, the federal regulator, in conjunction with the state being the primary regulator, would be the Federal Reserve. The other half of our banks are non-member banks, of which the FDIC would be the federal regulator in conjunction with the state of Montana. The 64 state chartered banks have over $20 billion in assets. By comparison, there are 6 national banks, of which there is $1.3 billion in assets. We are also responsible for the examination and supervision of state chartered credit unions. We have 9 credit unions that are chartered, one of which is a corporate credit union, Treasure State Corporate Credit Union, that is located in Helena. Our agency is also responsible for the regulation, licensing, examination of non-depository financial institutions, of which there is 1,200 licensees, and those would include the mortgage brokers, mortgage lenders, consumer loan companies, consumer finance companies, deferred deposit lenders, and title lenders in the state. Getting to the crux of the Wall Street Reform Act, it is 2,300 pages, and I'm sure many of you have read it several times. But needless to say, it is a long and complex bill. The scope of financial regulatory reform has grown exponentially. By comparison, by looking at some of the other banking acts and laws that were passed over the years, the Banking Act of 1933, the Glass-Steagall Act. This law was passed in the midst of the Great Depression and represented a major overhaul of our regulatory system, which established the FDIC, which ensures our deposits for our customers in our banks, the Free Open Market Committee, and it also separated commercial banking from investment banking. Congress was able to accomplish this task in a bill that was less than 40 pages long. But in 1999, legislation was passed to repeal the Glass-Steagall Act, and the Gramm-Leach-Bliley Act was passed. And in the provisions of that act, which primarily was to repeal the Glass-Steagall Act, was to provide consumer protection and privacy notifications that our depository institutions had to provide to their customers. This was accomplished in a bill that was 145 pages long. Fast forward to today, while the financial crisis that we've just experienced was considered by many to be second in intensity only to that which took place during the Great Depression, the question I have, and I think the question many of you have in your mind, is how are our citizens, our consumers, our banking industry, our non-financial institution industry, and the regulators to interpret this 2,300-page law? The value of this law is going to rest in the construction and the prudent construction of administrative rulemaking. There is an estimated 250 different sets of administrative rules that will come out as the result of this Wall Street Reform Act. 67 independent studies, of which it is expected that over 150 will have an impact. Administrative rules, separate sets of administrative rules, will have an impact on our community banks. I would like to point out the provisions of the new law and more directly speak to the impact that this act will have on our community banks. Turning to Title I, it's the financial stability provision. This title addresses the core purpose of the bill by creating a new oversight regulator, the Financial Stability Oversight Council. This council of regulators will monitor the financial system for systemic risk and will determine which entities pose a systemic risk. They will evaluate risk-based capital, leverage, liquidity, concentrations of credit. I have a fellow commissioner in the state of California, Bill Hariff, who has been appointed to the Financial Stability Council. There is a voice of the state banking departments that exist on this council to assure that our community banks are represented. Another key provision of Title I is to provide our community banks that are less than $50 million, and it's not a very large bank if you're under $50 million in assets, that excludes the Tier 1 capital calculations for trust preferred securities. So our bankers and certainly our investors in this audience will appreciate the fact that this amendment would have been if this amendment did not occur in the Act, there would have been more capital that would have needed to have been raised by our community banks. I'm moving to Title III of the Act. Title III addresses the regulatory structure. And in this provision, I think the significant change that occurred was the merging of the Office of Thrift Supervision, which is the federal agency that oversees savings and loan banks, into the Office of the Comptroller and the Currency. The thrift charter will remain. Another significant portion of this title is the dual banking system is preserved. Our banks will still have a choice between a state and a national charter. The Federal Reserve Bank supervisory role is preserved, and state-membered banks will have the state as a primary regulator and the Federal Reserve as the regulator for their bank holding companies as well as their bank. The state non-members would be supervised by the FDIC at their bank holding company structure as well as the state banking departments. Another key provision that occurred within this title was an amendment that Senator Tester proposed. And it was after he heard the concerns from our banks in Montana. And that related to the assessment for deposit insurance. The FDIC charges banks an assessment for the deposit insurance that is provided. Similarly, the state of Montana, my agency, charges an assessment for the work that we do to our banks in the examination and supervisory requirements. But it was in this provision that the banks that were larger, and the assessment would be based upon the asset size of the bank versus the deposit size. And in time, over the next 3 years, it is estimated that our community banks will save $4.5 billion as the result of this amendment. Under this title was another key provision, and Gail has spoke to this, and it's something that is of importance for our borrowers, and that is the permanent increase that the FDIC insurance has per depositor from $100,000 to $250,000 in deposit. It also extends the unlimited deposit coverage for non-interest bearing transaction accounts. I'm moving to Title 10, the Bureau of Consumer Financial Protection. I think this probably from a regulator's perspective and also from a bank's perspective as well as a consumer's perspective, the Consumer Financial Protection Bureau is the most significant aspect of this new law. It will alter in dramatic form the manner in which consumer lending occurs with our banking institutions. As you've heard, it establishes the Consumer Financial Protection Services Bureau. It is going to be an independent entity that will be housed in the Federal Reserve Bank. And I think the reason the Congress looked at putting this bureau within the Federal Reserve Bank, not to be controlled by the Federal Reserve, but to be housed there, is it gives it the startup capital it essentially needs of $500 million for this agency to start its work in enforcing the important aspects of this legislation. It also provides, as Karen has explained, provisions and practices to prevent unfair, deceptive, abusive practices that occurs by lenders. The legislation of the Federal Trade Commission and our own Consumer Protection Act in Montana also utilizes the same terminology. So it's fortunate that there is the consistency in the terminology that is used between the federal legislation, the FTC law, as well as the Montana Consumer Protection Act. For our community banks in Montana, those banks that are under $10 billion, and it is all of our community banks, including First Interstate Bank, as well as Glacier Bank. The primary enforcement authority will come from the Federal Reserve Bank for Fed member banks and the FDIC for those non-Fed member banks, in conjunction with the primary regulator, which is the state banking departments. I have my 2-minute note that I need to wrap up. A couple of areas that I wanted to impress upon was Title 12, improving access to mainstream financial institutions. This title is intended to provide alternatives to payday loans. It is encouraged to provide low-cost, moderate-income individuals to have access to accounts in insured institutions. In summary, we had the privilege of listening to Senator Jon Tester right after lunch. And it was Senator Tester's role with this law that was critical to the outcome. And in his role that he served on the Senate Banking Committee, and it was the key to the success of this legislation. I had the opportunity of working with Senator Tester's staff. Allie O'Donnell is present. Allie, if you wanted to stand up. We'll embarrass her here. Allie and I had several phone calls together, met with Senator Tester, discussed how these provisions of this federal Reform Act would impact our institutions in Montana. Senator Tester is to be commended for fully engaging our Montana bankers, our consumers in the state, as well as our regulatory agencies and my agency for the outcome of this legislation. Thank you.
Thank you, Andy. This is a dead mic here. And now we'll turn it over to our final panelist, Bill Bickle, who is the Chief Credit Officer for Stockman Bank of Montana, based in Miles City.
Good afternoon, and I'll see if I can break the mic or do something constructive. The way I'll approach the financial reform is really from the perspective of a practical community banker within the state of Montana, dealing on a transaction-by-transaction basis with our customers. And we certainly appreciate the opportunity to speak here today at this conference and recognize all the work that went into putting this together. The important thing to remember, I believe, is that there's a significant difference in terms of business model and business practice between some of the large national institutions that have been discussed from time to time today, the Bank of Americas and the Countrywides and the Citigroups of the world, and what goes on within the community bank, such as operates most of the banks here within the state of Montana. The large national players use a transaction model. When they're selling to you as a consumer, their goal is to maximize the profit that they can achieve off of the particular transaction that they're trying to sell at that particular time. In the community bank world, in the Montana banking world, we operate with a different model. It's called a relationship model. And it comes from the fact that we, for the most part, live in relatively small towns and relatively small communities. And we understand that our relationship with the consumer is not limited to just one particular transaction, but our profit and our relationship is driven by a large number of transactions over an extended period of time. And if we treat our consumers unfairly, if we treat them deceptively, if we're abusive in how we treat our consumers, that individual is not going to come back to our institution for another transaction, and we will lose or we will break the relationship. Accordingly, as we look at Wall Street, we have to remember that what we have here in Montana are not the masters of the universe on Wall Street that were running a particular casino particularly badly. That's not what we did in Montana. Rather, what we have here in Montana is a banking system that in many ways already operates under the standards that have been set forth in the goals of this legislation. I think that in working with Senator Tester's office, and particularly the senator himself, he recognized and understood the value of the Montana business model, and it was very beneficial to have somebody on the banking committee who understood and wanted to preserve and protect the culture we have here in Montana, and also the rural voice at the table as well. Nevertheless, as a lot of people have said, the devil is in the details. The banking community as a whole would rather that financial reform had not been passed, because even with the best intentions and the best efforts, it is still puts the community banking model at jeopardy. And the practical question from a banking standpoint and ultimately from a consumer standpoint is where the threats are to the Montana community banking model. The first, I believe, is the area of too big to fail. It is unconscionable that there are large institutions in this country who are simply too large to fail, and therefore their misdeeds have to be accepted and paid for. We hope as a community bank that this legislation will actually address and resolve too big to fail. However, there are other observers out there who are credible. Tom Honig, for example, the president of the Federal Reserve Bank of Kansas City, and a well-known community banking advocate who questions whether the legislation will actually achieve that goal. It is undeniable that particularly with the large institutions that they needed to have more capital than in fact they had. The legislation addresses that. However, it also increased the capital raising burden on the community banks and the banks here in Montana. We need capital. We should carry capital. Traditionally, Montana banks have. But if we have to increase our capital structures, that is going to decrease our ability to lend money within the state of Montana. As we said, the devil is really in the details on this legislation, and where I'll go next with this is commenting on some specifics that have been largely addressed by others on the panel, but maybe coming at it from the perspective of a particular banker. The Bureau of Consumer Protection. There's positives and there's also negatives in this bureau from the perspective of the bank. But irrespective of which side of the philosophical divide of this argument you might be on, there's also, I believe, some issues in the structure of the Bureau itself. First off is the power of the director. Unlike most federal agencies, the director, without the benefit of an advisory or a governing board, runs the Bureau. Now, if you happen to agree with the director, that's going to be perfectly grand. If you don't happen to agree with the director, that's a problem. The issue that we have to understand with our government is sometimes your guy is going to be on top and sometimes not. And what's really important for the banking system and what's really important, I believe, for consumers and the economy is stability and consistency within our regulatory structure. It's not a matter of who has momentary advantage. It is developing a system that can consistently, predictably provide a standard of conduct and a standard of accountability. The other matter that I believe is important as a banker is banking, as Annie would attest, is a balancing act. We have to balance our responsibility to our depositors, to our shareholders, to our customers, to our regulators. Traditionally, albeit perhaps not very well for some of the large banks, but traditionally, within the traditional regulatory structure, within the FDIC, for example, there was a consumer voice at the table. There was also a safety and soundness voice, a prudential regulator who took the position from time to time. This regulation may make perfect sense from a consumer point of view, but it creates excessive risk within the banking structure. As we look at the structure of the Bureau today, it is exclusively and uniquely a consumer point of view. From the consumer point of view, that may be perfectly fine, but in terms of developing consistent regulation that works fairly for all sides of the transaction, the consumer and the banker, which is ultimately what we're after here, the Bureau needs to take into account the prudential point of view represented by the regulators. The Bureau is going to start with integrating the Reg Z and the RESPA regulation. I assume most of us are somewhat familiar with those regs. All I can say is good luck. It is the two most complex regulations we deal with. It involves the most important transaction of a consumer's life. They should mesh together. They don't. One of the things I thank myself every day for is that I'm not a line lender that has to explain these regs at a loan closing to my customer. And if the Consumer Bureau can actually integrate these two regs so that they work well together and effectively, they will have done a good job. Likewise, Elizabeth Warren has been making repeated statements about simplifying the disclosures. Once again, a very good idea. That is, I think, as a banker, also going to drive simplification of product. Once again, I think that is a good idea. I think it is what the customer wants, I think it is efficient, and I think it is clear, and I think it is honest. However, we also have to understand that as we simplify the products and simplify the disclosures, we are also going to have to standardize some of these products and disclosures. And the drawback to that, particularly in the rural economy, particularly as we deal with some of our seasonal workers, agriculture, timber, whatever the case may be, there's also unique situations out there that require, at the consumer level, unique solutions. And as rural banks, as community banks, we also need the flexibility to take care of the unique situations that affect our individual consumers. The mortgage lending has been discussed in some detail. I will skip over all of the complexity there to come to probably one or two general conclusions from a banker's perspective that I also think has a direct effect on our customer and the consumer. The mortgage business is going to get more expensive for a bank to produce a mortgage. It is going to become more complex, and it is going to become, from a regulatory standpoint, more risky. Banks who choose to remain in the mortgage business are going to have to deliver more resources and more expense to deliver those products to the consumer. For banks the size of Stockman, First Interstate, Glacier, other banks that operate within the state of Montana, we have the economies of scale to do that. The smaller banks, the $50 and the $100 million community banks out there, which are a critical part of the Montana banking scene, do not have those economies of scale, and already the bankers that are in that situation in those smaller banks and in those smaller communities are having to make a very difficult decision as to whether they can afford to be mortgage lenders anymore or whether they're going to have to exit the business. From the consumer standpoint, I would submit to you that there's 2 points. First off, any time a provider of product leaves the marketplace, it hurts the competitiveness of the market, and potentially it hurts the pricing and the benefit that a consumer can realize. Secondly, if, for example, you're Summit Bank in Ekalaka, Montana, and you leave the mortgage banking industry, then what are the people in Ekalaka supposed to do to receive a housing loan when you're the only lender in the market? And one could say, well, it is only Ekalaka, Montana. That's true. But that's very important to the consumers and the community in that particular market. The other aspects as we work through the bill, some are important, some are not. Some of them we're going to see. But I think the most important thing from the consumer side as I wrap this up is the preservation of our business model and the preservation of the viability of consumer banking under financial reform as we go forward in the state of Montana.
Thank you. Is this on?
You're on now.
Thank you, Bill. And thank each of the panelists. It's I'd like to give a round of applause to them now. Steve, can we cut into your time by a few minutes here and take a couple questions? So take a few questions, and if you have a direct to one of the panelists, go ahead and do that. If it's a general question, we'll throw it to the panel and let them field it. So, ma'am?
We keep hearing that the regulators are the reason that small business credit is constricted, and I haven't heard anything about credit quality in any of the reform measures. There was any concern about small business credit quality. So my question is, are you concerned about small business credit quality? Is that what has constricted things, or does it have more to do with some kind of pressure you're putting on the capital structure of banks related to how much small business credit they have on the books? And whether you have a concern over small business credit quality.
I'll make a really quick comment since I am not a safety and soundness examiner. I think Annie might be able to comment on that as well. But I think one thing to remember at least when the board has issued these rules, and I'm one of the unfortunate people that has to read them when they come out, the Federal Register, and they always include in there a discussion about balance. So they balance the interest of the consumer against the costs of the regulation. Now, you might disagree with their end result, whether the costs may outweigh the benefit of the regulatory change, but they've always been cognizant of the fact that you can't require a bank to make a bad loan. So when you're talking about consumer protection, you always have to balance it against the fact that we as a regulator do not want our banks to make bad loans. Now, the issue of the availability of small business credit is hard to comment on at a macro level because that's at an individual bank level and the borrowers that they're looking at and the credit quality of the individual borrowers. But the issue of consumer protection always has to be weighed against the safety and soundness issues as well.
I think Karin's remarks were very good. In terms of small business lending in Montana, lending has not stopped in the state of Montana to our small businesses. In fact, I think one of the reasons that our community banks in Montana have done well and there have not been any bank failures is because of the prudent, conservative underwriting practices that they have done for a number of years, and that has served them well up to the last several years of which we've had some economic stress. We're also seeing another factor of small businesses not wanting to have advances of credit because they're being much more conservative due to the economic situation that we are in. About 3 weeks ago, Congress passed a law, and it was signed by the President, and it was the Small Lending Business Act, and it provides a pool of $300 billion to community banks, and it was focused directly to community banks to provide small business lending. And it would also substantiate that with SBA guarantees to facilitate those type of loans. So it is yet to be seen whether our community banks in Montana will take advantage of that opportunity and the grant that has been provided by Congress.
I'll be very brief. Montana banks are booking new business. Stockman's business loan portfolio in 2009 increased by 15%. We're online this year for about a 8 or 9% increase in business lending volume. We have seen some lenders, mostly large national lenders, leave the market. I think the most important thing from the business perspective is that this recession has been long, it has been hard, it is continuing, and more businesses, formerly very strong liquid businesses, are reaching deteriorating financial condition, and it's getting harder and harder to lend to them. And for those businesses on the margin, the perceived criticism of our regulators, and I'll be tactful here with my primary regulator sitting next to me, the fear of criticism is a dampening effect on some of these businesses that have been weakened.
Sir.
This is what I came for. Appreciate all your input. I wanted to give you a little bit of perspective.
From my perspective,
I look at the big picture. We're spending $1 million a minute in Iraq and Afghanistan. We've given multi-billion dollars in bailouts to banks and bankers. And we come in with a small business from a small little town in Montana where you've got some qualified people. And let me talk to you about a very personal thing. My daughter is an accountant. My wife had a successful business for 20 years. We sold the building. She went back out of the business. My daughter wanted to get back into it. They're in it. The business is doing extremely well. They went. They're two women, aren't they? They're minorities. And our good old white father, great white father, says we want to help women and minorities get into business. I had to guarantee their loan, $45,000 loan. Think about this. We're sending $1 million a minute in Iraq, and we can't take a risk on a local small business into town on somebody that is educated, both have college educations, 20 years of successful business, an accountant, wants to get into business in a town where it's been successful, and they require the male figure to guarantee a $45,000 loan. What if you lost it? It would have paid for the machinery, the people would have sold the refrigerators, the freezers, or the chairs, or whatever they're going, computers, whatever they're going into business, that would have gone out to the community and we'd lost it. Yeah, the good old government could have guaranteed it. But you can't get that loan. When you talk about doing business, you're talking about marginalized loans.
Sir, I'm sorry to interrupt. Do you have we need a question?
Well,
or-
all right. When are you going to stop talking about getting loans to small businesses in small town Montana and actually do it? And I appreciate what you're saying, but it doesn't ring a bell with me. And I've been around for a lot of years. Thank you.
That's what you get for being the bank.
And also at the end of the line. Sir, I appreciate your comments. I won't comment to the specific situations because each loan decision is difficult from time to time. First off, if a guarantee was required on otherwise qualified female borrowers, that's a violation of Reg B, and a bank that engaged in that will hear about it from their federal and state regulator. Secondly, in this economy and at these times, there are difficult lending decisions. It is to the financial benefit of every bank in Montana to make every qualified loan that they can, because that's how we generate the earnings that supports our capital and supports the additional lending of the bank in the community. Everything, as a community banker, everything I do that strengthens my local community, it works to the benefit of my community, and it works ultimately to the benefit of my bank and my shareholders.
I think we'll take one more question and then we'll. Yeah, right here.
Yeah, I guess this question is drawn on a comment you made, Bill, about how what seems to be the effect at this point of the new law is that community banks, there's a chilling effect. They're getting out of the consumer finance business. So if that's the case, then won't the ones who are left standing are going to be the Morgan Stanleys, the Goldman Sachs? And doesn't that seem counterintuitive? Kind of defeats the purpose of what's been done so far?
You know what? I'm going to give Gail a chance to address that, and then anyone else who would like to.
One of the things that we have seen again and again with what some people call predatory practices, some other people just say unfair practices, is that in many markets, one player, sometimes a big national bank, pioneers a practice. I mean, this happened with overdraft loans to some extent. And then they're making so much money on it that smaller banks feel like they have to follow it. Because otherwise, if someone has bringing in a lot of money on an unfair practice, they can they can make something else cheaper and make the product look better to the customer than it really is. When we have CFPB writing rules that apply to everybody, big bank, small bank, non-bank, whatever you are, the same rule applies, there will be the opportunity to cut off that kind of bad competition and open up the market for good competition. Now, are we there yet? Are we going to be there tomorrow? No and no. But we have a chance to get there from here.
I do agree with that. The leveling of the regulatory playing field between not only the big banks and the smaller banks, but between the shadow industry, the non-banks, and the banking industry can, particularly if the regulation is uniformly vigorous across all of the various institutions, benefit the industry as a whole. One of the comments I made to Senator Tester's office, and Allie has been very patient with me over the last 6 months, was that only in America could we start out to punish Wall Street and end up hitting the community banks over the head. To some extent, and I'm sure there are those who disagree with me, there is a danger that this is what has happened in the legislation. I hope not. That's why the drafting of these regulations that are coming down the pike are so important. But the concern you've expressed, sir, is the concern of community bankers across the country.
And I'll give a good bureaucratic response, since I guess that's what I am after 20 years. One thing I will say, the statute is fairly specific on some of these rules, but there are a lot of regulations that need to be written. You as a consumer and an individual can comment on that process. The Federal Reserve, at federalreserve.gov, they have a regulatory reform website. They are committed to including in there all of their proposed regulatory changes that are coming out of the Wall Street Act. And it's fairly easy to comment. You can send an email. I will make a note, if you're shy, your comment will be made public on the website. Now, only a few of us actually go in there and read those comments, so I don't think you have to worry too much about it, but just know that it'll be public to some extent on the website. But I think it's an excellent opportunity if you've got concerns about if you're a community banker or you're a resident of a small community and you're concerned about how these laws are going to affect you, definitely take a few minutes, look through some of the proposals and comment on them as a way to get your voice heard. They do read all of those, so that's what I would suggest.
Well, thank you again, panelists. We knew when we put this together that covering some of the subjects that are as important and far-reaching as we're dealing with in the time available was going to be difficult. Again, I'd refer you to the website for more information from some of the panelists here, and there's a lot out there to be read. So we're going to now turn it over to Steve and for some comments, but before we do that, I'd like again to thank the panelists that have shared with us here today. Thank you.